Hello and welcome to the US Non-Farm Payrolls live webinar with myself, David Madden. I'm a market analyst at Equity Capital here in London. And Equity Capital is a part of a wider equity group, which also includes FX Pesa in Kenya and also Equity Nigeria in Nigeria. Now, just before we actually get into the webinar itself, I'll kind of run through the risk warnings. It essentially states that anything that is covered in this webinar should not be construed as investment advice or trading ideas. It's purely my own thoughts and views and opinions. Now, I hope everyone can actually see the screen okay. What you should be seeing in front of you, is the FX Pesa logo up here, powered by EGM Securities. And the risk warning here is stating that trading in margin products can carry a high level of risk. So what I'll do is I'll go kind of straight into it in terms of some of the big moves that we've seen in the markets in the last few weeks. What you should see now in front of you is a chart of the US 500, the S&P 500. The price action we've seen on the US 500 has been very volatile, and it's been kind of uniform across equity markets around the world, both in North America, here in Europe, and also in Asia. And also what we've seen as well is we have seen similar price action in the US dollar. So before we discuss, what the finer details of the US jobs report, what we're expecting and the likes, we need to first of all take stock of what's going on in the markets the last few days. So starting off here with with this large spike that was seen, or this large rally that was seen on Wednesday. The US 500 hit a multi-week high on Wednesday after we heard from the Federal Reserve. The US Central Bank issued although they hiked interest rates by 50 basis points, 0.5%, overall, the update was less hawkish than expected. So what that means is they didn't give off the impression that they're going to be continually rising interest rates by large amounts on a regular basis. So further interest rate hikes are in the pipeline, but we probably won't see another 50 basis point hike for a while, or at least for a few meetings anyways. And the result was we saw a sharp move to the upside in the US 500. Then what we saw was a sharp move lower yesterday. It's almost like seems to be a kind of a delayed reaction that although markets had a very positive reaction to it on Wednesday night, by Thursday daytime and Thursday afternoon, the story very much, their feelings to a 50 basis point hike had very much changed. Keep in mind, when interest rates go up, the cost of borrowing goes up. And why is this important? Well, for those people out there that regularly rely on credit card spending, their payments will start to go up. For people making mortgage repayments on their homes, their payments will start to go up. And also for businesses, certain sectors, particularly the technology sector, is typically more heavily indebted than other sectors. And as a result, their interest payments are going to start to rise as well. And if we can see in the pipeline that more and more interest rate hikes are on the cards, that's likely to actually kind of keep putting pressure on both companies and individuals. And what it all kind of accumulates means if people at the end of the month have less money to spend because of higher interest rates, that'll chip away at demand. If businesses are deterred from, or dissuaded from expanding their business by borrowing money and expanding their business, that's going to ultimately impact business activity and demand. So with all this feeds together, it has a negative sentiment in the markets, and in turn we've seen a sharp move lower. What's quite remarkable is that the lows that we've seen in the last few hours on the US 500, they've actually managed to kind of drop below the pre-Federal Reserve interest rate decision announcement time. So not only did we give up all the gains, we're actually back down to levels last seen in advance of the Fed meeting. So that in itself is quite bearish. Looking here at the MACD indicator, we can see that momentum is in negative territory, indicating that the bears are in control. Looking here at the RSI, it's been moving lower as well, indicating that the price bias is to the downside. Now, just to point out, I am looking at a 4-hour chart here. All the charts I look at, I'll be showing are 4-hour charts. And what we can see here is that these lines you see along here, these are moving averages. So this is the 20-period moving average, the 50-period moving average, and the 100-period moving average. So the broader kind of bearish, while we continue to hold below these 3 simple moving averages, it's like the broader bearish trend will continue. So if we do continue to move lower from here, we could retest the recent lows of 40.61, and a break below that could see a target 40.50. Now, if you do manage to kind of turn around and have a stage another rally, because let's face it, in the last few weeks and months, we have seen some pretty large rally, the snapbacks such as here, 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 and also here. If you do manage to stage a rally from here, where could we potentially move to? Well, I've been looking up toward this moving average here, which essentially acts as resistance. It's the 100 period moving average, and it comes into play in around 42.81. So if you can rally from here, this is potentially the first kind of barrier to a rally as a possibility. And if we were to break above that, we could target this area here in around 43.71, and a break above that could see a target this zone here around 44.31. Now, this here is US 500. I'll take a quick look at the UT 100, the NASDAQ 100. And what we can see here is the price action is quite similar. It enjoyed a rally on Wednesday night, but didn't last long. The market turned quickly lower. And in fact, the lows we set in the last 12 or 16 hours are actually fresh 14-month lows. So once again, with the UT 100, similar situation to the US 500, the market rallied Wednesday night, then had a very aggressive sell-off. And we're now actually managed to kind of undo all of the gains that were made on Wednesday night. Similar situation in terms of the MACD indicator. Momentum is firmly in negative territory, suggesting the bears are in control. Looking at the RSI, that's at the lower end of the range as well, also indicating that demand, so also indicating the price bias is to the downside. If we were to continue to move lower from here, we could look to head back down towards these areas around 12,622. Gonna break below that, could see us back down to 12,288. Looking at the price action here, we can sort of see there's been some sort of very loose support area being found here. You know, notice how the low that we set here isn't too far away from the low that was set here. We're already moving lower yet again. So the kind of broad bearish sentiment, you know, if you can manage to kind of form a base in around here, it's possible the market could look to kind of hold above this area. If that is the case, and we do kind of turn around from here, where could we go? Well, we could head back up toward this moving average here, the 100 period moving average. And this is an interesting situation. It happens from time to time. Notice how if you follow this line along here, the 100 period moving average acts as resistance here, 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 and here. There's about 6 or 7 occasions all along this line here, basically over the past month, where the 100 period moving average has acted as resistance. Now, if a metric has, what I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So clearly that we've been in a downward trend for the last few weeks for the UT 100. Selling the rallies has been a popular strategy. And what people are looking at, you know, where exactly do I short a market? Ideally, if you want to if you want to capture as much of the market move as possible, you ideally short it just before the market is about to turn around. So traders have been asking themselves, if we do see a rally from here, where could we potentially target? We could head back up to this area here, because let's face it, there's been a number of occasions the market's rallied to this point and then turned lower. And that comes into play around 13,471. If you were to have a big break above that, we can see it's up to this level here around 13,775. Now we have 5 minutes left before the numbers come out. I'll take a quick look at euro dollar. Obviously, the euro has been in the news a lot recently, given that a short while ago, euro dollar back here around this time last week, euro dollar had fallen to a 5-year low. So similar situation to stock markets. The euro dollar had a very impressive rally on Wednesday night, largely because of the broad sell-off in the US dollar. But then yesterday, the Bank of England, they hiked interest rates, but they also predicted that next year, in the year 2023, the UK economy will contract by 0.25%. That was quite a stark warning. The pound suffered across the board, and as a result, the US dollar got pushed higher. So euro dollar moved lower yet again. So we can see a bit of a base forming in around here, but broadly speaking, you know, while we continue to hold above these two moving averages, it's like as a more medium-term bearish trend will continue. Moving north from here, we can have to retest 1.0470, and a break below that could see it down towards one spot 1.04, and then 102, and then parity itself. But I think that's kind of a long way off for the time being. So what are we looking out for in terms of the jobs report? I'm looking here at this particular economic calendar. Forex Factory is the one I often like to use. We're expecting a reading of 390,000 jobs. That'll be a fairly good number, but it'll be a drop compared to the previous month's number of 431,000 jobs. We're expecting the unemployment rate to fall to a new 2-year low. It's currently at a 2-year low of 3.6%. We're expecting it to edge lower to 3.5%. In my experience, when it comes to the US non-farm payrolls report, there isn't just one number coming out. There are multiple of numbers coming out. There's the headline figure itself, which everyone, in my opinion, pays too much attention to. Then what you have as well is you may or may not get a revision to the previous month's number. You know, the last few months we have seen some quite big revisions, almost to the point where the revision can be almost as important as the actual headline number. And we also have the unemployment number, the unemployment rate. And in my opinion, they should be all taken as one whole, kind of amalgamated all together, and then it's making your assessment from there. Is it a good jobs report? Is it a bad jobs report? The reason why the Federal Reserve hiked interest rates last week is because they feel the US economy can withstand it. They feel the US labor market is strong, which it is. Unemployment is at a 2-year low, basically the lowest level since the pandemic. But a large part of the reason why the hiked rates was because high inflation. Now we do have inflation numbers coming up next week on Wednesday. And if inflation continues to kind of ratchet along and continue to move higher, that could renew talks of the Federal Reserve might need to have more interest rate hikes and larger interest rate hikes. Now, it is worth noting this before we get 2 minutes left on the clock. Essentially, what's today's numbers people are going to be looking at. If we have a weak jobs report, that on one hand could push back the idea that the Federal Reserve that could add weight to the argument the Fed aren't going to hike interest rates at a fast rate, because if the labor market is showing signs of weakness, the last thing we want to be doing is hiking interest rates. On the other hand, so in a scenario like that, we could see a rally in stock markets. Chances are we probably see a decline in the US dollar. But at the same time, if you see a bad number, that could really speed up fears going, oh, the US economy contracted by 1.4% in the first quarter. The economy is weakening. We're now seeing job numbers fall off. That can actually speed up the decline we've seen in stock markets. And in that kind of scenario, a bad jobs number would be bad for the US dollar. If you do see a good jobs number, we could see a bit of a continuation of the recent upward move in the US dollar. If you see a strong jobs number, what we're doing for stock markets, it would probably hammer home the idea that the Fed are going to continue on their track of hiking of more interest rate hikes this year. It would have to be at a very impressive number, like 800,000 or 1 million jobs for people to kind of change their attitudes to go, you know what, the Fed aren't going to have a 50 basis point hike sooner rather than later. So I don't think that outcome is fairly unlikely. We got less than a minute on the clock, so I was kind of waiting now to see what the numbers come in at. Another economic calendar I like to use here is trading economics. Just waiting until the numbers come out. I'm seeing here, United States non-farm payrolls reported 428,000 jobs, basically almost in line with expectations. It just needs to double check that that's correct. The unemployment rate, by the looks of it, held steady at 3.6%, slightly, not meeting expectations of edging lower to 3.5%. So the headline numbers came in 428,000, better than expected. There was basically bang in line, unchanged from the previous month's number. Actually, the previous month's number was revised ever so slightly lower from 431,000 to 428,000. Today's reading came in for April, came in at 428,000. The unemployment rate remains steady at 3.6%, which is good, but still economists were expecting a dip to 3.5%. Overall, I would say it's a fairly bland report. It's a respectable report. Well over 400,000 jobs were added. there's a slight revision lower. Basically, you would say it's almost irrelevant. A slight revision lower on the previous month's number, and now that we have the revised number for March and the new number and the actual number for April, we can see that there's no change. The unemployment rate held steady. I would suggest, given the week we've had, is it going to be a fairly muted and boring response by the markets in relation to non-farm payroll. So I don't think we're going to see much of a move in the US dollar or even US stocks for that matter. But the overall kind of takeaway message is that the labor market is in pretty good condition. You know, the Federal Reserve gave an update on Wednesday, just gone, saying that they would reduce their balance sheet, essentially the assets they've purchased over the last few years. They'd begin reducing that by $47.5 billion per month from June. Now, keep in mind, going into that update, economists were expecting it to be a 95 billion, so it was a smaller reduction than expected. Although the Fed said they will increase it to a $95 billion per month reduction come June. Sorry, after 3 months. So I don't think today's numbers, one way or another, are going to influence the Fed's policy. You know, the Fed hiked by 50 basis points a couple of days ago. They gave off the impression the next hike would probably be a 25 basis point hike. We'll probably see a few 25 basis point hikes from the Fed, and then maybe towards the end of the year, September, October, perhaps another 50 basis point hike, depending if it's needed. No one really thought the impression that the Federal Reserve are gung-ho to have another 50 basis point hike, and today's report would add weight to that argument. It was pretty good, but not so good that the Federal Reserve needed to think about having another rate hike. So I'll take a look now at GBP USD, see what the instant reaction has been. For anyone out there that has any questions, I'm happy to look at markets. What I'm planning on doing is scanning across a few other markets. I'll look at some of the big US indices. I'll look at gold. I'll look at some dollar crosses. If you have any questions or any markets you want me to take a look at, feel free to kind of enter in the chat box what markets you want me to look at. And chances are that the markets you want me to talk about are the ones I'm planning on talking about anyways. So we can see here on the reaction from this is the 1 minute chart. You know, you don't really kind of glean too much from a 1 minute chart, but it's nice to kind of see the reaction. So you can see here the market instantly moved higher. The pound instantly moved higher against this. People just thought, took this as a sign of that. Right, the pound was very weak yesterday. They're using the opportunity to kind of step in and actually buy up the British, buy up the pound versus the dollar. I don't think it's a particularly weak story for the US dollar, but keep in mind the pound dollar was very weak going into this. Keep in mind, a few hours ago, pound dollar fell to the new 22 month low. So pound dollar was weak in advance of this. Therefore, because people were kind of afraid, what if the US numbers are strong? The US numbers aren't strong, but they're not particularly weak either. They're perfectly in the middle, and we've seen a bit of buying. But nonetheless, you can't really escape the fact, if you look at the 4-hour chart, only a few hours ago or overnight, pound dollar fell to a new 23 month low, which really kind of sums up how bearish the market is. Momentum is firmly, these red bars here on the histogram are firmly in negative territory, suggesting the bears are in control. Looking at the RSI here, we can see it's very much at the lower end of the range. It hasn't moved into oversold territory, but it's not too far away from it. So if the broader bearish trend continues, where could we go from here? Well, I'll be looking down towards 1.23, 1.22, 1.20. That is provided we continue to hold below these three simple moving averages. If they let's see how things play out. If you do manage to kind of stage a rally from here, let's face it, this candle here has a fairly long wick on it, which often can denote indecision. So if you look at this candle here, where it has the red rectangle at the top and then the very kind of thin line coming off of it, that when you have a thin line coming off a candle, that can often denote indecision. Not to say the market is definitely going to turn around. It might just trade sideways for a bit, but it can be an early warning that a turnaround is in the offing. If you do see a turnaround from here, where we potentially target, well, we could look to retest this peak here in around 1.2637, and a break beyond that could target this zone here around 1.2771. One of the markets that's been very volatile recently has been the gold market. Now, gold is traded in US dollars, so whenever the dollar gets very strong, gold typically comes under pressure, because if you're in the Eurozone, if you're in the UK, or if you're in Japan and you're using your foreign currency, be it Japanese yen or euros or British pounds, trying to get your hands on dollars first in order to buy gold, a stronger dollar tends to hurt gold, a weaker dollar tends to help gold. That being said, what also influences the price of gold is what's called the flight to quality factor. If stock markets are falling through the floor, people are, and they're selling their shares because they feel the economy is going to go into recession or whatever, and stock markets are falling. When they're selling their shares, they're freeing up cash, and often what they do is sometimes buy gold, because gold is perceived to be a safe haven play, a safe haven investment. So you have these two forces going on at the same time. We had a strong US dollar because the Fed hiking interest rates on one hand. What that was doing was the increase in the US dollar was pushing down gold, but at the same time, the losses in gold weren't too bad because stock markets were falling for the same reason. Stock markets were falling because of fears about higher interest rates. So when stock markets were falling, people were buying gold. So gold was being driven lower by the stronger dollar, but it's being kind of pushed back higher again by the flight to quality play. So it's kind of been almost like in between a rock and a hard place. So look at the price action in gold in the last few days. We saw gold, like other assets, like stocks, rally on Wednesday night when the Fed issued a statement that wasn't as hawkish as expected. So, and then yesterday, because of the strong rebound in the US dollar, we saw a sharp move lower in gold. And then we appeared, even though we've handed back a lot of those gains, it's worth noting in the very short term, we still do appear to have some sort of an upward trend in place in gold. So gold, although it's lost a lot of ground yesterday, the lows that we saw yesterday were still above the lows that were set before the Fed meeting, and they were certainly above the lows that were set at the very beginning of the week. So I'm starting to see what this could be, may not be, it could be the beginning of a turnaround in gold. That being said, we really can't ignore the fact the much longer term trend for gold is to the downside. And when it comes to trends, a longer term trend will typically take precedence over the shorter term trend. So when I was looking at gold, I was looking at this and saying to myself, right, on one hand, while we continue to hold below these two simple moving averages, the 50 period and the 100 period, I suspect the longer term downward trend in gold will continue. That being said, and if that is the case, and we do move lower from here, we can look to retest this area here around 1861. And right below that, could see us back down towards 1850, the lows of May. That being said, I've been looking at this price action very carefully and thinking to myself, right, the bigger picture for gold is still lower, the bigger trend. But at the same time, you can't really ignore the fact that we've seen a higher high, a higher low, a higher high. Granted, an aggressive move lower, but still a lower high, our moving higher again. So you've got to kind of visualize the trade. What's gold going to do? Is gold going to rally here and counter resistance from this trend line, or perhaps encounter resistance, around this point here, around kind of just north of 1900, or encounter resistance from this moving average and then turn lower yet again? Or is it going to break above that, smash above the trend line, smash above this peak here, and then go on to 1919, and then beyond up towards 1945? This is the sort of situation that I'll be thinking about. To be perfectly honest, in a scenario like this, where I can see a market as is potentially about to turn around, I might actually, even though I might have a bearish view, I might just play the kind of wait and see card and see how things go. So for example, if gold were to kind of struggle to retake this trend line, I'll be potentially looking at that as a sign that the market could be turning over on itself again and continuing in the broader bearish trend. Or if gold does break above the trend line, I can simply say, no, a change in trend could be in the offering. Because let's face it, gold has had a pretty tough run the last few weeks and months. One of the elements, one of the aspects of trading, or one of the kind of aspects of trading I apply is Dow Theory, and Dow. There are several components or several principles of Dow Theory, and one of those is that the averages must confirm each other. And what that essentially means is that markets that are quite similar to each other typically move in the same direction at the same time by roughly thereabouts the same amount. So what you do is if you have a view on gold, for example, it's worth your while taking a look at what's going on in silver, because in theory anyways, if gold is moving in a certain direction, you'd probably be seeing a similar price action with silver. So we can see here with gold rallied Wednesday night. Gold rallied Wednesday night and it has since pulled back. What are we seeing here with, I got somebody asking for XAU USD. So I'm looking right here at gold as we speak. Like I said, you know, the longer term trend for gold is to the downside. You know, if you look at the price action, this line here from mid-April onwards, you can see a sharp move lower in gold. Although we've rebounded a bit, we're still holding below these two simple moving averages. While we continue to hold below these two simple moving averages, it's like the broader bearish trend will continue. Moving lower from here, we could retest 1861 and go below that, break below 1850. Now, at the same time, I am conscious of the fact that even though the medium and longer term trend is lower, the shorter term trend is higher. So look at the price action here. We've rallied all the way up to here. We've had a pullback. The lows we set here are comfortably above these lows here and these lows here. It's possible the market could be turning around. No, it could even do both. It could even rally to this point here around 1900 and turn lower again. We don't know. But in the very short term, I think in the very short term, the trend is to the upside. So if we continue to hold above this trend line here, it's possible we could target around 1900, 1910. Where do we go beyond that? That'll be an important question. That will be an important junction as far as I'm concerned. Are we going to break higher, or are we going to turn lower yet again? So it's coming onto there with Dow Theory. Look at the price action of gold. We've had a rally Wednesday night and a sharp move lower, and we appear to be turning higher again. Are we seeing something similar with silver? XAG. This here is the silver market, and not quite, but we're seeing something similar with silver. So we rallied a Wednesday night, and then we had a sharp move lower. We're off the recent lows and we're turning higher again. So this is what I mean about Dow Theory. The averages must confirm each other. And what that essentially means is, if you're thinking of taking a view on gold or silver, you know, one way or the other, buying it or selling it, you shouldn't, if, for example, if you observe that gold is in a very short-term upward trend, and you also see silver in a very short-term upward trend, you can be more confident that gold's upward trend will continue, because the two markets are quite similar and they typically move in the similar direction at the same time by roughly the same amounts. If the markets are not moving in the same direction at the same time, that tells you something is up, and that's usually the indication not to do that trade. It's about kind of, what I would call kind of stacking the deck in your favor. There are examples of if you observe gold's trending higher and you observe silver trending higher and you buy gold, there's no guarantees that gold will continue to go up. It might turn around, it might go lower, but you can be more confident of that upward move in gold if you see silver move higher as well, if that makes sense. So the price action in silver is quite similar to that of gold. Therefore, anyone who trades silver should be keeping an eye on what gold is doing, and anyone who's trading gold should keep an eye on what's going on with silver. The question here is what should we expect on the dollar's price movements after the news? I think kind of a muted US dollar, to be perfectly honest. I said at the time it was a pretty good report. I don't think it was going to change one way or massively change the direction of the dollar one way or another. This year is euro dollar. Euro dollar this about a week ago or 10 days ago fell to a 5-year low. So the really big picture for euro dollar is to the downside because of the strong dollar. I know we've handed back some of those we pulled back somewhat, but the broader kind of bearish picture for euro dollar is still very much in play. Like I said, if we continue to move lower here on euro dollar, where could we go? Down towards 104, 102, parity itself, but I don't think we're going to be getting parity anytime soon. Apply Dow Theory to currency markets as well. So we looked how there's a broad downward trend in euro dollar. What's going on with pound dollar? Very similar situation. Only a few hours ago, pound dollar fell to a new not quite 2-year low, but 22-month low, 23-month low. So euro dollar at a multi-month low, recently hit a multi-year low. Pound dollar is close to a 2-year low. You're building a picture here of a strong US dollar. So I think, you know, the broader bearish trend of GBP USD is likely to remain intact as long as we continue to hold below these 3 simple moving averages. Looking now for dollar yen. Yeah, I'll take a look at AUD USD. Once again, the Australian dollar versus the US dollar. Very similar situation. You know, the lows that we set only a few days ago, we're back to levels last seen in January. So we're back to multi-month lows we're kind of at a 4 or 5 kind of 4-month low in 4 or 5 month low in Aussie dollar a few days ago. What did we see? We saw a sharp rally in AUD USD. It didn't last very long because the broad resurgence in the US dollar, and now we've moved lower yet again. So it looks as if, you know, if AUD USD continues to hold below these 3 simple moving averages, it's likely the more medium term, the short term bearish trend will continue. Moving lower from here, could it retest 0 spot 70.29, and a break below that could see us down towards 0 spot 69.66. Now, if you do manage to kind of hold above the recent lows here, or if you do not drop below this low here, the multi-month low of 0 spot 70.29, that could be an early warning sign the market's forming a bit of a base and it's looking to move higher yet again. If we do rally from here, where can we go? Well, potentially up toward this peak here around 0 spot 72.65, and beyond that up toward this zone here around 0 spot 73.48. So I've been speaking now for about half an hour. I've had a few questions so far. Any more questions you want me to ask? Just absolutely, you know, feel free to fire away. To be honest, I actually, you know, I'm more than happy to talk about whatever markets you want me to have a look at. To be honest, I actually prefer when I actually get asked questions. It's just actually because when I get asked questions, it typically drags me away out of from the markets I usually look at. I'll take a look. I got a question here of how long can the indices go with the 50 basis points hikes since we expect a series of hikes? Does this mean a perennial bear market for equities? I'm a bit nervous when it comes to the state of play. I take a look again at, say, the S&P 500. You know, the S&P 500 on Monday fell to a 1-year low. A few hours ago, the Nasdaq 100 fell to a 14-month low. I'm a bit nervous for the state of stock markets, to be perfectly honest. I think, you know, it really was quite something when we had a sharp rally here on Wednesday night. You know, the peak here just about cleared these 2 peaks here, not by much, but just nonetheless ever so slightly. And things were looking like, oh, this could be a large turnaround. And it didn't last very long. And then we had a brutal decline yesterday. And then once again, I reiterate, the losses we've set in the last, 5 or 6, 10 hours, 12 hours are below the levels that were set even before the Fed had their, less than, not particularly hawkish update. With that, this is why I think if you can't hold on to a gain for a long time, it's almost an indication of how bearish the market is. Well, I'll be using, I've got a bearish view on US equities, provided they continue to hold below these moving averages. For me, the big level to watch out for is the UST 100, the Nasdaq 100. The Nasdaq 100 has been the main kind of the biggest gainer to say 2020 and 2021, and now it appears to be the biggest loser in 2022. What I'm really and whenever you do see a large sell-off in US stocks, that typically influences European and Asian markets. But within the US itself, it appears to be the technology sector. The Nasdaq 100 typically is the one that is souring sentiment across the board. And I go back to this chart here, the 4-hour chart, 3 moving averages on the screen, a 20 period, the 50 period, and the 100 period. And I go back to what I said earlier on. There's 6 or 7 times in the past month the 100 period moving average has acted nicely as resistance. So, think about this. A downward trend is defined as a series of lower lows and lower highs. We have the lower low, the lower high, the lower low. Tries to get back higher again, fails. Tries to get back higher again, fails. Falls down to, kind of whatever it was, 10, 12 month low. Rallies here after a Fed meeting that wasn't as anywhere near as hawkish as people thought. It can't even break that moving average. Can't even breach that level. And then it drifts a bit lower, and then it crashes and then hits a new 14-month low. To me, I would look to hold an optimistic view for the UK, for the UT 100, the Nasdaq 100, until we have a comfortable break above this area here, this moving average, because it's been acting as a barrier to any gains we've seen in the past 4 or 5 weeks. So while we hold below that barrier, I think that the broader trend for the UT 100 for American markets and therefore kind of almost to a lesser extent Asian and European markets is also fairly bearish. I'll take a look now at oil. We can see here on oil, it hit its highest level in a few weeks in the past 12 to 16 hours. It was back up to a level last seen in late March. The upward move in oil wasn't a total shock. About a week ago, we heard from Germany, and they stated that they were dropping their opposition to an EU-wide ban on Russian oil. So as soon as that was announced, people thought, right, it's only a matter of time before the EU come out and ban Russian oil, which they did. They did during the week. Now, to be fair, it's not an outright immediate halt of the importation of Russian oil, but what it is, it'll be a phased program over the next 6 months, and with that, we have seen an upward move in the price of oil. Like I said, hit its highest level since late March. So we're talking 6 week highs have been set. We're comfortably above all three of these simple moving averages. Even before we had the announcement about the EU, it was already still in a kind of broad upward trend. You can see it by the price action. It was already moving higher even in advance of it. So while we continue to hold above these three simple moving averages, I'll suggest that the broader upward trend will continue. Moving higher from here, we could have the target $113.21, and a break beyond that could see us target the late March highs of $115.81. Got a question here. I'm a newbie. What can I trade AUD bullish? Well, like I said, I've already kind of covered what's going on with the gold market. If you are, the question about gold is, gold in the kind of the very short-term trend on gold is higher, but the more medium-term trend in gold is lower. So who knows? It's possible gold will continue this short-term upward move and possibly target around 1895, 1900, or possibly up towards 1910. But until we actually kind of break above this trend line here in around kind of 1910, 1915, I think it's the kind of the broader bearish trend is likely to remain in effect. Is it advisable to use Fibonacci levels? You've not used any fibs in your analysis. I like the broad idea of Fibonacci retracements. I'll show an example now of what a Fibonacci retracement is for those of you that don't know. Earlier on in this webinar, I mentioned Dow Theory, and one of the principles of Dow Theory is that when a market has there are various principles of Dow Theory. One of them is, if a market is trending, be it an aggressive trend higher or aggressive trend lower, the trend will remain in effect until you see a significant move in the opposite direction. Now, how do you define what's a significant move from what isn't? That is subjective, and this is why trading is hard. But also, one of the kind of principles that also covered in Dow Theory is that there are trends within trends. And for example, what you can see here is this short-term upward trend could just be a reaction to the kind of broader bearish trend. We could continue a short-term trend, move lower, and slot back into the broader bearish trend. So for example, we saw a very short-term upward move here, but only to move aggressively lower yet again. We saw a short-term upward move here, only to move lower yet again. And the fact that if you look at the price action here, we have an aggressive move lower, an upward move, a short-term uptrend, a larger downward trend. So we can see there are trends within trends. And one of the tenets of Dow theory is that whenever you do have a move in a certain direction, you will often have a retracement, and that retracement typically will be most retracements are between 35% and 65% of the preceding move. So it's kind of similar to Fibonacci. Fibonacci, yeah, they're obviously more exact price points, but I would apply the same principle of Fibonacci in that when a market has a significant move in a certain direction, you're likely to see a counter trend, and that counter trend could be, as Dow theory states, 35%, 50%, or 65% of the preceding move. Dow theory reckons that the majority or clear majority of retracements are between 1/3 and 2/3, 33% and 65% or 66% of the preceding move. That's not a million miles away from the levels that are mentioned in Fibonacci retracement. Now, like anything, when I mentioned looking at the NASDAQ 100, talking about how if a metric has been of importance in the past, it makes it more likely to be of importance in the future. That can be applied to Dow theory as well, and Fibonacci. It's not putting blindly picking out a level saying that, oh, I'll just take an example now. It's not putting blindly taking out a level such as euro sterling. It's not putting blindly taking a level saying, I think this particular Fibonacci retracement, is going to be significant, or I think this moving average will be significant. You want to see if a certain metric, be it a Fibonacci retracement point, or a moving average, or a trend line, or or whatever it is, or a resistance zone, has a track record of being important. If it has a track record of it being important, it's more likely to be of importance in the future. If a Fibonacci retracement level, or a trend line, or a moving average, or a resistance zone doesn't have a track record of being important, it makes it less likely it'll be important in the future. But there are no guarantees. So if you observe the price action here, this is very rough guide stuff here. We did a sharp rally here on the euro sterling, and then as a reaction to it, the market moved aggressively lower and had a pullback, which is the counter trend. And then what was the next move again? A leg higher. So this is what I mean by trends within trends. The overall arching trend is higher, but that is made up of one long upward move, a pullback, a retracement of the preceding trend, and then another move higher. So this is what I mean about visualizing the trade. If we are trending higher, the upward bits are going to be, in theory, much longer than the downward bits, and then we're going to have another long upward bit again. So the rallies are much bigger than the counter move. So off the top of my head, I can see that when it had this upward move here, I can see that it's pulled back around probably 20-25% of the preceding move. And applying Fibonacci, this is it here with the F's over it. If you place it in here at the bottom of the pile, actually, first things first, I'll just delete these trend lines. We're coming up now on the hour, so I look to be wrapping things up shortly, but applying the basic tenets of Fibonacci. If you take a look at the price action here, we can measure the entire move. So we can see here with Fibonacci, if you look at starting with the base down here and the peak up here, how much of a retracement did we see? Well, the Fibonacci as a certain price points mapped out, a retracement of 23.6%, a retracement of 38.2%, a 50% retracement, and a retracement of 61.8%. Once again, the principle with Dow theory, where a market will have a significant move and then will pull back between 1/3 and 2/3 of the preceding move. It's the same general idea, but different price points. We can see here that after the market made this move, on some occasions, the 23.6% actually were significant. On some occasions here, the 38.2 was significant. Didn't even get pretty close to the 50, and then the market moved higher again. So I would just be looking at it and saying I would back test it, and if a market in the recent history has a track record of regularly respecting certain Fibonacci retracements, whichever it is, 23.6, 38.2, the 50, the 61.8. If it has a recent history and track record of respecting those levels, then I would say yes, I would use Fibonacci in that instance. If it doesn't use it, I wouldn't blindly just going to go, oh well, we've no track record of respecting the 38.2 retracement level. I'm going to put in a buy order there. Now, in this instance, the market rebounded, so it actually would have worked. But just because it happens every now and again doesn't mean it always happens. All I'm saying is that the more a metric has a track record of working, the more it'll continue to work in the future. It also becomes a self-fulfilling prophecy, because if a lot of people out there use Fibonacci, and they spotted that a certain resistance point or retracement point has a regular track record of winning, more and more people will do it, and therefore more and more people will buy up a market or sell a market at a certain level, if that makes sense. I've been speaking now for 45 minutes, so I'll look to wrap things up there. Before I look to finish things, I will say this. If you do have any questions for me, feel free to contact me on Twitter. My Twitter handle is at @dmadden_equity, at DMADDEN_EQUITI, dmadden, at dmadden_equity. I obviously, I can't give you any advice, and I won't give you any advice. But if you do have any questions for me, like, what's your, have a look at, please have a look at, gold or the US 500 or whatever it might be, I'll happily do a tweet and basically kind of have a picture of the chart on the screen, like I do here, where I was covering a tweet here about the DAX yesterday, where I'll do a tweet. I'll kind of mark out a couple of what I consider to be significant price points, and then see what happens from there. And then write some commentary around it, saying that this is what's going on, this is the prevailing trend. If the trend continues, we could target X and Y, or if the market turns around, we could target levels A and B. So once again, I do want to thank you for your time. I appreciate those who stayed till the end. Feel free to contact me. I'm also hosting every single Thursday a Scan the Markets webinar, which goes out at 6 o'clock Nigeria time and 8 o'clock Kenya time. And essentially, I run through a handful of markets and talk about the big news. I will be hosting a non-farm payrolls webinar this time next month for the next set of figures. So feel free to sign up for that. I'll look to wrap things up now. So everyone, have a good Friday, enjoy the weekend, and hopefully talk to you soon. Have a good one.